Hello everybody, in this video, I am going to teach you another trading strategy. It is similar to my other trading strategies that I have uploaded on this channel, but with a slight variation. It has only 3 rules. Guys, your strategy should be simple. It shouldn't be complicated. There should be some rules, and you should follow those rules like a robot, no matter what. There are 3 rules to this trading strategy. So we look for an ABC pattern liquidity sweep. Okay, so what is the ABC pattern? We move in one direction, and then we move in the opposite direction, and then we move in a third direction, exactly the same as the first direction. So it's an ABC pattern here, and the C leg comes over the A leg. And similarly, if you're looking longer, we move in one direction, and we have a step in the opposite direction, and then we have a step in the first direction. And if we want to go longer, we take out, sweep the bottom of the air leg. And in this scenario, if you want to go short, we look for this pattern, and we look for this pattern if you want to go along. I hope that that is clear. If it isn't clear to you, you can go and watch my previous videos and it's going to be clear to you what is an ABC pattern. Once we have identified an ABC pattern liquidity sweep, now what is a liquidity sweep? So we have the A leg, we got the B leg. And when price sweeps the low of the A leg, this is called liquidity sweep. And in this example, in this diagram, you can see we have an A leg, we got the B leg. So this is a major swing high. And a lot of people have their eyes on this level. And when price sweeps this level, this is called ABC liquidity sweep. I hope that's clear. And in this scenario, it would be the low of the A leg. So we look for the ABC pattern liquidity sweep. And the rule number 2 is we wait for market structure shift, change of character, whatever you want to call it, inside the range. Okay? So let me add this in inside the range. Now, what is a range? This line that I've drawn on the high of the air leg, anything below this line is a range. And I want the price to change the corrector or break the structure below this line. So if I make this realistic diagram, let me try it again. We got the A leg, right? And we got the B leg, right? And we will go, when we are about to sweep the high, we're going to make structure like this, so we got this. We got this. Why is this so clumsy? And we got this, right? Okay, so when price, the C leg, sweeps the A leg, the high of the A leg, we should create some structure. If there's no structure, then we don't look for trade. But if there's structure, we wait for price to come back down and break this structure. It could be a candle, low, or it could be an actual low, right? So you should know how to identify a low. I'm not going to teach you how to identify a low because this is a very basic, guys. And if you don't know the basics, you should not be watching this video. Instead, you should be watching what is support and resistance because these are. Anyways, let's just keep on talking. So we wait for a market structure shift and we take our entry from the extreme variability gap and boom, we target the low of the B leg. This is our target level. We do not chase the price lower. We just target this level. So this would be your take profit level. So we got another clear demonstration. This is a real life market, how it should look. We would have a decent size, a big, decent A leg, and then we would have a decent size B leg, and then we have a liquidity sweep, which is the C leg. So size matters, guys. That's what she said. So you can see we have an A leg, which is quite big. It doesn't need to be that big. It just has to be a decent size. And I'm going to tell you what is a decent size. Then we have a B leg, and then we got the C leg. And when the price is going for a C leg, it should create structure like this inside the range. And when it sweeps the liquidity, we wait for market structure shift. Now, price should not go this higher. It should not create something like this and keep on going up. And then when it comes back, no, this is not valid. Because price might go and create another ABC pattern by literally sweeping this high. So make sure price doesn't go that high. You just want to see this as the actual. It can go this higher, right? Or it could go. This is the max length. This is somewhere around here. And then it should come back and break the structure, which would be this. And we take our entry here and we target this level. And we're looking at the 5-minute time frame, and we should only be looking at one time frame in this trading strategy. And let's go here, and I'll try to give you guys an example. If I can find, there you go. So as you can see, we have this A, B, C pattern, right? So if I mark out the high of the A leg, we sweep out the liquidity and we have this structure that was created. As you can see, that was created before price swept the liquidity, right? We should be only looking for this level. However, you can see the low of the B. The low of the B leg was already taken before our entry. So this setup becomes invalid. However, you can see that we still have a valid ABC structure. So we still got this A, B, and then we get the C leg. So it can continue. So we got the high of the A leg. We sweep this level, and then we got this low here, right? As you can see, we break the low. And this structure, as you can see, was created before price touched this line or swept the liquidity. So please notice, please listen to what I'm saying. This is very important. So when you draw out the high of the A leg or low of the B, or low of the A leg, it depends on what trade you're taking. If you're taking long or short, you mark out, let's say, in this example, you mark at the high, right? If price goes up, touches this line, and then comes back, and then breaks up again to sweep the liquidity, then that structure is not valid. However, if price creates, so we can see we got the higher high, higher low, higher high, higher low, higher high, higher low, and then we got a liquidity sweep. Before price swept the liquidity, we created this structure. And this is a valid structure for me. So after the liquidity sweep, we wait for market structure shift. And as you can see, we have market structure shift at around this level, and we look for fair value gap. So there's no fair value gap here or imbalance, okay? But you can see that we have this fair value gap right around here. So if I mark the fair value gap right here and I take my entry and I put. Now, where to put your stop loss? You could either put it at the high or you could put it at the body of the candle. Okay, you could put it at the body of the candle. A little higher would be fine. And what is your take profit level? The low of the B leg. So this is the low of the B leg, right? So if I see this, you can see that we hit the take profit level and then we instantly reversed, guys. Look at the accuracy of this thing. It's nuts. So I'm going to give you guys a couple of more examples and then I'll end the video. So here's an example number 2. As you can see, we have the A leg, we got the B leg, and now we're about to make a C leg. What you do is you mark out the low of the A leg when you're looking for a long position. We wait for liquidity sweep, and boom, we swept the liquidity. We made this structure, right? We made this structure before liquidity sweep. So if I play this through, we should break this structure, okay? And there you go. We broke the structure, as you can see, and we want to wait for a candle close above this heart. We should not only consider, we should not consider the wicks. We should consider the bodies. Okay. And as you can see, we have this huge fair value gap. Okay. Now, there are two things that you can do when there is a big fair value gap. And if you don't know what fair value gaps are, you can search it up on YouTube. And there are a lot of videos on it. So you got this big, fair value gap. Now, as a normal person, you can take your entry from this big variable gap. But if you want to, if the gap is big or you want to take a new one, increase your risk reward, you can use the Fibonacci level from the start of the gap to the end of the gap. Right. And then you can take your entry from the 50%, which is right here. And then you can put your stop loss below the body or below this level, which would be this. So I will put it here. And if I close the fib now, where should be our take profit level? It is right here. The high of the B leg. Okay. And if I go here, this would be 4.86. But if we took our entry from the end of the federal gap, we would have a 2.86 risk reward rate. So let's go with that, okay. So we already have our entry. But let's see how this plays out. And boom, we came back mitigated. this auto blob right here. And we just pushed back up. So you can see how well this strategy works. Guys, so a very simple and easy trading strategy. Guys, this is absolutely insane. And then I want you guys to backtest it. Yeah, you need to backtest it. And rewatch this video again and again. And then you're going to understand this completely. So let's end this video and take care. Goodbye. Thanks for watching our video.